Hi everyone, Stacy Whiter here on behalf of Campus Mortgage with some tips for you on analyzing business returns, part 2 of a 3-part video series. Now just a quick reminder before we get started, this video is for informational purposes only and should not be considered legal advice or used in place of Fannie Mae guidelines. Also, this video was created on May 15th, 2017, and the information contained in this video is subject to change without notice. So we've talked about the types of business returns for partnership and limited liability companies. There's also S corporation and corporation. And in this video, we're going to focus on the S corporation. So when analyzing returns for an S corporation, some S corporations and LLCs will use the IRS Form 1120-S, Schedule K-1, for filing their federal income tax returns. And they often will pass gains and losses to shareholders, which are going to be taxed at the individual tax rate. Now, the shareholders' share of income or losses is carried over to their 1040 Schedule E form. Now, income may be in the form of wages or dividends in addition to the borrower's proportionate share of income or loss as reported on the Schedule K-1. Now, for S corporations, the proportionate share is based on the borrower's or the shareholder's percentage of stock ownership for the tax year shown on the current IRS Form 1120-S Schedule K-1. Now, business income may be used if the income was actually distributed to the borrower or the business has adequate liquidity to support withdrawal of earnings. Now, if this income is supported by the K-1, then no further documentation would be required for liquidity. Now, when reviewing the cash flow analysis, just like partnerships and LLCs, some items can be added back into the business cash flow. So that includes losses that are not consistent or recurring, depreciation, depletion, amortization, and casualty losses. Now, items that should be subtracted from the cash flow analysis include meals and entertainment, other reported income that is not consistent and recurring, and the total amount of obligations on mortgages or notes that are payable in 1 year or less. Now, these adjustments would not be required if the obligation is a line of credit or if the business has sufficient liquid assets to cover the obligations, or if the obligations roll over regularly. All right, everyone, that's all for now. Thanks so much for watching. For more tips and videos, please visit campusmortgage.org and look for their weekly video mortgage tips designed for all mortgage professionals, including underwriters, processors, loan officers, closers, and post-closers. Thanks. We'll see you next time.